The day you turn 62, you are asked to make a financial decision that could easily swing your lifetime wealth by $100,000. It comes down to a single question. Exactly how long do you think you will live? We are talking about Social Security. Think of it as a mandatory savings account you've paid into your whole working life, which then guarantees you a steady monthly check for as long as you're alive. You might wonder, if that money is guaranteed to arrive, why not start taking it the moment you're legally allowed to? Because taking it early comes at a steep price. To get the most out of the system, we need to look under the hood and see exactly how the government scores your career. This timeline shows how your baseline benefit is calculated. The Social Security Administration looks at your entire work history, but they only count your 35 highest earning years. They take those 35 specific years, adjust the wages for inflation so old paychecks hold their value today, and average them together. That starting score is called your primary insurance amount. But here is the catch. If you only worked for 30 years, the government forces zeros into those 5 empty slots. A zero heavily drags down an average. Having years with no income pulls your overall score down, meaning your monthly check is permanently smaller. Hitting a full 35 years of work is the absolute minimum requirement to protect your baseline score before you even decide when to claim. Let's assume you have your starting score. You only receive exactly 100% of that amount if you wait until what the government calls your full retirement age, which is age 67 for most people working today. This chart compares your options. If you want your money as soon as possible and claim at age 62, your check is permanently slashed by 30%. But if you hold off until age 70, the government rewards your patience. Delaying adds a 24% bonus on top of your baseline. Taking it at 62 means an 8-year head start on collecting total money. But because those checks are smaller, the delayed strategy slowly catches up. Right here is the break-even point. At about 80 years old, the steeper path of the delayed 70 strategy crosses and surpasses the early claiming line. So the math is clear. If your health and family history suggest you will live past 80, waiting until 70 results in thousands of extra dollars over your lifetime. If you are married, you get access to a secondary set of options. A spouse can choose to claim up to 50% of their partner's baseline benefit instead of taking their own, and utilizing the spousal option takes absolutely nothing away from the primary earner. Both of you receive your money simultaneously. However, keeping your money requires navigating taxes. Depending on your other retirement income, up to 85% of your benefits can be taxed. These combined income thresholds were set back in the 1980s and early 90s. Because Congress never updated them to account for inflation, everyday wage growth pushes more middle-class retirees into paying taxes on their benefits every single year. A mathematically perfect timeline means very little if surprise tax brackets and a lack of spousal coordination drain those gains away. You also have to factor in the health of the system itself. By the mid-2030s, Social Security's surplus reserves are projected to run dry. But this chart shows how the funding actually works. Even if the reserves completely empty out and Congress takes zero action, the ongoing payroll taxes collected from current workers will still cover about 80% of all promised benefits. Planning around these rules gives you a concrete playbook. For married couples, a common strategy is for the lower earner to claim early to bring in immediate cash, while the higher earner waits until 70 to maximize the monthly payout and the eventual survivor benefit. For individuals, it comes down to health and necessity. If you are in good shape, hold off as long as possible. If you need the income today, taking the early reduction is a perfectly sound choice. Your first step should be logging into ssa.gov to review your earnings record. If there are missing years or incorrect zeros, you can fix them right now before your score is permanently locked in. Social Security requires your active participation. Learning how the calculations work gives you the control you need to confidently lock in the right strategy for your retirement.